You can support this podcast for $3 a month at patreon.com/copytradersclub, or find me on eToro, username Gavin McCauley, and add me to a watch list for future content. Thanks for listening. Copy Traders Club, where you can learn how to make better decisions and more money copy trading. I'm Gavin McCauley, my name and username on eToro. My aim as an eToro enthusiast is to demystify this new and uncharted world of copy trading, understand what are the pitfalls and best practices, and how ultimately to succeed as a copy trader. Here we go. Yes, here we are back again for Season 3, Episode 26, I believe it is, of Copy Traders Club. And it's a roundtable episode. And you can see from the names on the windows who we have joining us today. We have Ben Sparham. Hello, Ben.
How are you doing, Kev? Good, thank you. Yourself?
I'm very well. I've just realised that I turned down everyone's microphones slightly, only to discover my microphone settings or my volume settings on my computer were quite high. So I'm going to be secretly doing that without anyone realising. As we say hello to everybody else. Pedro, how are you?
I'm fine, thank you.
Keep talking, Pedro, so I can adjust your microphone.
Okay, I'm fine. I hope I'm very proud to be present here with all of you.
Well, we're very proud to have you. And we're indeed very proud to have Heloise. How's Heloise doing?
Yeah, doing really well. Glad to be back in the Copy Traders Club. Looking fab as always, Gavin.
You are, or Copy Traders Club is, or I am?
All of it.
Okay, very good. Well, let me do a little bit of housekeeping here. I'm supposed to put this banner up, which runs across the bottom of the screen. You can see that. And also this banner, which introduces the first topic of today, current state of the market, 2023 year to date. How's it all gone? Did it surprise you so far? And what are you expecting for the remainder of the year? So let's start with Ben.
Yeah, so I think it's probably surprised quite a few people coming off of the doom and gloom of last year's bear market, right? For me personally, there's a few different bits and pieces that I obviously track to get a directional bias in terms of my portfolio and the market as a whole. So I've been pretty much 100% long since March. So obviously the rally off the October lows, obviously I missed a little bit of that. I had a little bit of a hedge in my portfolio at that time, but I switched 100% long in March. A very, very strong move, obviously predominantly from tech and a couple of other sectors, but tech's really been leading the way, which isn't a huge surprise because obviously tech was one of the worst hit sectors last year, right? So obviously when we kind of factor that in, whether you want to call it mean reversion or whatever you want to look at, it's not really the biggest surprise. But of course, you know, it still caught maybe some people off guard. The current state of markets, I feel like we're a little bit extended. We're going to get a little bit more to higher valuation areas. So once again, I've included a small hedge in my portfolio, only about 10%. That's obviously short the index, is a little bit of a hedge out to my long stock exposure. And then going into the back end of the year, I'm just a little bit more cautious, just for the fact that, you know, markets don't move in a linear fashion, no matter what direction it is, bullish or bearish. At some point, you're going to get natural corrections with any kind of underlying trend in the market. So the way that I'm looking at it, back end of the year, rather than being overly aggressive after already a big run up, you know, I'm conscious of the fact that, you know, if you offered anybody 20% at the start of the year, you'd be very, very happy, right? You'd snap your hand off. So the fact that we're already up 20%, there's no need to be getting aggressive at this point. I feel like it's more important to protect the capital a little bit. So small hedges in there, just tread cautiously, be careful of what I own and see how the rest of the year plays out. I wouldn't expect it to be as bullish as the start of the year, but you never know. Crazier things have happened, right?
They certainly have. And I wonder when we hear everybody's responses, am I going to be right in thinking that you, among the three guests, are the most responsive to the markets? You sort of talk and sound like you're very much keeping your finger on the pulse. You're little bit more of a trader, I would say, than the others. But I'm open to being proven wrong, and you're going to resist. You're going to resist the term trader, I know, as soon as I said it. Go ahead.
Maybe. I mean, obviously, I can't speak for the other guys and their styles, right? But I mean, I'm not scared to react to something. I also track the macro environment as well. So, whilst the market may not have responded in the way that I believe it should yet, if there's certain elements on a macro level that I'm cautious of, then I will obviously be react to that and be a bit more responsive to those types of scenarios. So, look, in my ideal world, I'd like to buy a stock and own it forever, right? But obviously, that doesn't always work out that way. It will depend on my sector view, my industry views. If I believe there's more opportunities elsewhere, I'm more than happy to rotate the portfolio. And if I believe an idea either isn't working out or there may be a better opportunity elsewhere, I don't have any problem chopping something out and bringing something in. So, yeah, maybe in that sense, maybe I'm a little bit more reactive. I've got no issue, putting the trigger on something, basically.
Pedro, I know you like to, when I watch your little shorts and things like that, all the stuff you put out, you're sort of a disciple of Buffett and those kind of guys. I wonder whether you are adopting a more serene approach to market movements and a much longer term view, or am I wrong in thinking that that's basically where you're coming from? Have you been reactive in 2023?
Well, I of course I have a long-term view, but I also like to pay attention to macro themes that are present in the current environment. I think I have a similar view of Ben in terms of positioning the portfolio at the present moment. And when I invest, I think we never know what will happen in the next day. So we have to put our portfolio in the perspective of our vision, but the reality will surpass that and we must adapt. As you said, and as I was saying, I put my portfolio in the long perspective. But I must acknowledge that the rise in the markets in the present year was a little bit sooner than I expected. But since I have my portfolio position for a long perspective, I went with the ride up. But now I see that I don't see the rally going up much more until the end of the year. Maybe revisiting the S&P higher prices of 2022. So I'm trying to rotate to a little more defensive positioning. I'm meaning a rotation of sectors, but also looking for other geographies that are cheaper, and there are other markets that are more cheaper than the US. And in addition to that, not being so Warren Buffett style, I like to see some macro themes in Forex, in commodities, and even in bonds. So it's a value plus macro, but my vision for the end of the year, it's a little more defensive positioning until the end of the year.
Interesting. I've just been looking at your stats, all three of you. I suppose I could share that now before we come on to Heloise, because this is quite interesting. If you look how similar these monthly graphs look. This is Ben, Heloise, Pedro. Not huge shifts there, month by month. You see February and August to date are red in everyone's. So I wonder, what do we learn from that? It doesn't really matter what your overall overarching approach is, because the markets are going to do what they're going to do. Or Heloise, maybe you can talk us through what your approach to 2023 has been so far.
Yeah, I can definitely echo both Ben and Pedro in saying that that sort of rotational recovery, which started in October, came a lot sooner than I think a lot of us anticipated, and you can see that in the performance. But then again, if you compare those performances, we're all sort of generally long-term investors. I think that's one of the things of a lot of popular investors, not all of us. And so there are those little incremental kind of levers that you can pull as you try and adjust the portfolio. For me, a lot of that sort of rotation to more cyclical stock, more defensive stocks happened last year. Of course, last year was tough for many of us. And then there was that decision about, as you know, my portfolio has always been more sort of geared towards US tech stocks. Those were, as Ben said, the hardest hit in the turndown. So there was that decision point whether I'm going to stay largely focused on that, whether I'm going to rotate fully away from that. And then finding that kind of balance in the portfolio where I think you continue to deliver what you committed to your copiers, whether that is kind of, in my case, more moderate risk over kind of crazy returns, and then how do you actually implement that in the long term? And then I think, as both have pointed out, how do you make sense of that, I guess, in the macroeconomic sense? Because I think this year has been a surprise for a lot of us, but also not really, given how the markets have gone. It's been so unpredictable. It's not followed the textbooks. And I think the key learning for me has been, or not learning, probably a reminder, is using history and theory and what we think should happen as a sort of guideline, but not forgetting that the markets are heavily driven by emotion. And especially in the UK right now, we are not seeing that fear coming in for a potential recession. If you go to London, to any of the high streets, the restaurants, the shops are packed and people are spending money, which no matter what the government or the Bank of England is trying to do, inflation won't come down as long as we don't have that fear in the consumer for the potential, tough times that are ahead. So just trying to make sense of all of that, and then remembering that, common sense fits into all of this, and your own interpretation of what's happening on the ground is important as well.
Yeah, for sure. I mean, there's been just so much talk of economic doom and gloom, inevitable recession, indicators that have never been wrong in the history of man. And now you're saying recession cancelled. Is the recession cancelled, Ben, in America, in UK?
I think the reality is nobody can ever predict a recession. That's kind of half what creates a recession in the first place, is that we end up with a scenario and the way that the economy and the consumer and everything rotates. But I mean, I'm not of a believer, for example, I mean, the yield curve is the biggest one, right? That everyone keeps pointing to. The yield curve has never been wrong, right? Well, okay, well, that might be the case in the US, but across the globe, it has been numerous times when we look at other countries. And also, there's only been 7 occurrences of it. So if you was to, some people will be watching this, for example, that are quite quantitative and use a lot of data. Well, whenever you backtest any data, if something had happened 7, 8, 9 times, you wouldn't look at that as a pattern. So to me, it doesn't make any sense to look at the yield curve. Don't get me wrong. I look at it in the sense of how the market is pricing risk, but I don't look at it as a recession indicator. I look at it as it's literally telling me where, how the money markets are pricing risk, and that's it. I'm not going to sit there and say, well, all my other macro data sets that I look at, such as, ISM data or consumer sentiment, things like this, they all look maybe, a bit more solid, but the yield curve is negative. So therefore, I'm going to sit there and say, oh, well, that's it. Then that's what's going to happen. You also have to look at it as well in terms of taking the yield curve for what it is, in the sense of what the data represents and shows you. Because yes, the yield curve is currently inverted, but we typically don't see a recession until that inversion actually, reverts back the other way, until we go back to a more normal, stable yield curve. So if you're looking at it from that sense, well, technically speaking, if you also want to go off of that, well, we shouldn't have a recession all the time it's inverted. The real worry should come once we go back the other way and come out of that, right? So it really, I think you've got to almost take it with a pinch of salt in terms of how you use that kind of data, in that one data doesn't mean everything. it's hard sometimes because when you look at, Bloomberg or Reuters or whatever, wherever you get your news from, there's always doom and gloom or fear and stuff like that, because that's what sells. So from a media aspect, that's the thing they're always going to push. There's always a narrative. There's always something to put fear in there. So I would, as a bit like Heloise said, use a bit of logic at times, use a bit of common sense, look at what's going on around you. Don't just listen to the talking heads on TV. Say, okay, but what am I actually seeing from a consumer aspect? As Heloise said, you go to the shops and things like that, they're all still packed. So yes, that obviously has the negative side of things in terms of the inflationary pressures possibly. But then there's the other side of it. We're going, well, that clearly isn't the habit of a recession either. So it kind of goes both ways. So I think you've got to factor it all in together and never just look at one piece of information, and then balance your portfolio accordingly to the risk that you see fit, not that everyone else talks about and what's the talking heads on TV are saying, basically.
Yeah. Look at what's going on around you. Pedro, you're in the beautiful city of Lisboa, and you're invested in some Portuguese companies, were the last time I looked, and I think some other European ones. Can you give us the European perspective on the economic scenario that you see around you?
Yes. Well, I see the economy is as Ben said, is resilient. In Portugal, particularly, it's strong. There's a lot of new business opening, but I see in the current environment a recession, maybe later than we all expected. Well, we are going to have a recession. We don't know when it will happen. So I think that the current situation, and I'm monitoring more the US than Europe because it's the main economy. Maybe in the present year we don't have a recession for sure, but there are some elements that we can see it in the future. For instance, this week we saw the numbers of maritime containers that are slowing down. So I'm projecting of course, we are only speaking about probabilities, but even in a strong economy like we are here in Europe and in the United States, I with this high interest rate that will take longer than we all expected, the high interest rate will happen for sure for a long time. This will lead almost for sure in a certain point the economy to break down, and this is the way to fight inflation. So and this is why I'm balancing my portfolio now in a more defensive perspective. But of course, we are speaking about medium term, maybe next year, because in the present moment the economy it's very strong in Europe and in the US also.
More money is lost waiting for a downturn than in the downturns themselves, they say. If you want proof of that, you can refer to my performance 2023. But Heloise, I just checked the cash balances of all three of you, and you have the largest on about 17%. So is that an indicator of your caution still this year, that you're not all in? Ben has 0 and Pedro has about 7 or 10, did I just see?
It's around 10.
10%. So 17, Heloise. Talk us through that.
I think definitely out of all three here, I probably have the more pessimistic outlook. I think sort of Pedro kind of touched on that, but I'd say we're definitely expecting, I don't think the recession is cancelled. I think we can sort of expect it later towards the end of 2024. I think every indicator is there that the economies globally do need some breathing room. We've just come out of a decade of having really, really cheap money going around, and that's created a whole generation of people who probably don't understand the value of money in certain economies. I'm from a developing country, so I think we look very differently at things like inflation and the cost of money. But that will certainly, come back, and there is a lesson to learn from that for the whole economy. There has to be some relief. There has to be some trimming of the fat that happens in the economies. The cash balance that I'm currently holding is much smaller than it has been throughout the year. I think I started the year at about 30%. So it shows you how much I've moved towards a more certain position about where we are. But I have been talking about this L-shaped recovery for almost a year now, which I anticipate us to see. And it's because of this scenario where I think governments and banks are just sort of delaying the inevitable. Unfortunately, I wish they'd just get on with it personally, but that's how it's playing out. And so the cash buffer is really there for sort of short-term, more opportunistic trades. We've seen some kind of short selling passing through my portfolio, which isn't something that has happened in the past, but that I have been doing this year just because of my outlook. And I think I continue to hold that buffer to allow me to take these opportunities more rapidly. I don't want to be fully invested at this point.
Okay, well, you heard it here first. Recession's coming at the end of 2024. Until then, there's a chance for us to make
billions and 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 billions.
So that's good news.
How much?
All right. Shall I play it again?
No.
I think we got it.
Okay, well, that takes us to the end of part one. Part two is coming up, and we're going to talk about a stock that you all own. Okay, we're going to talk about a stock that you all own and we all use. That is Visa. So you all own it. And the big question is why? But I suppose I need to dress it up a bit more before passing that over. Isn't it just a safe, okay kind of stock, Visa? When you see it in someone's portfolio, you think to yourself, well, it's never going to do very much. It's never going to be significantly undervalued. What's the point? Now, let's start with Pedro. And Pedro, while you start answering this question, I'm going to show the relative position of Visa in everyone's portfolio. So why do you own Visa, Pedro?
Well, I have Visa on a perspective of a diversified portfolio. I think Visa, in terms of fundamentals, as being present in the global payments, is gaining space in terms of the traditional banking. And if you look, for instance, at the global consumer spending will increase by 6% a year until the end of the decade. So Visa has a lot of presence in this space, so I think they can grow. I even think that Visa can benefit from the transition to fintech because it's not a traditional banking company. And even in I think Visa has a possibility of entering the crypto space. We have already the Visa cards, for instance, from Binance, from Crypto.com. So, and I think that this system works. I used to have 4% of Visa in my portfolio. Now I've closed that position. It enabled me to have 14% in 8 months. So I think it's a very decent profitability for this position. I closed 2% in terms of a kind of rotation to financial sector in Europe. I have a European bank. I have also not a bank, but an insurance company that also is related to the financial sector. So I think there's more value there than in Visa because of the prices in the US are a little bit up. I like, for instance, the net profit of Visa. They have almost 50% of net profit. That's a lot. In terms of target price, even at the present moment, we see, for instance, the main perspectives in terms of target price are around 15%. So given the perspective of the S&P related to the eye of 2022, I think Visa maybe it's prepared to going up more than the index. So I still think it's a good stock to be in the portfolio.
Yeah, on that issue, in fact, this is 10 years. And you can see Visa's performance against the S&P. It's unbelievable, really. According to the parameters of this, the S&P is 166% up, and in that time frame, Visa's up 466. That's pretty amazing. So, makes me wonder, when you look at things like that, free cash flow per share, dividend growth, both been rising consistently over the years. So is it a buy anytime and hold forever stock, Heloise?
I think both Visa and MasterCard, because they're the only two players, but they've both been excellent shareholder value, as you've just pointed out, both in terms of the capital growth that they've offered, but also the sort of dividend distributions. If you look historically, it's obviously been a great buy, but the question is it still a great buy today? Of course, we all sort of think that. We still have it in our portfolios. It's like, why one over the other? Like, for me, I've had both Visa and MasterCard in the portfolio. I'm currently favoring Visa over MasterCard purely because of its geographical kind of exposure. Visa is much more of the revenue comes from the US, which is a much more advanced market in terms of cashless payments. Whereas MasterCard is much more global in other geographies. And we're seeing that sort of trend moving in the developing markets. But I think that will be a much more competitive market. They're harder markets to get into for the cashless payments. And obviously, they have a lot of challenges coming up. So I think, like I'm sure everybody else here, when you put a stock in your portfolio, you always continue to reevaluate whether you want to continue having it in your portfolio. I think the Credit Card Competition Act of 2022 will sort of challenge a lot of what's happening with these two companies, perhaps open it up for some competitors to come in, which might be a great thing. The one thing that I love about both of them is, which might be, sort of a negative for some people, but they have, both of them have really high percentage of operating margins, around 60%. So for me, that tells me that these are both companies that are reinvesting into making sure that they're staying ahead of the technology, that they're making sure that the platforms they're building are really strong. And once that's done, the operating to maintain those can be really inexpensive. And it's also just showing that they're sort of reinvesting to make sure that they are remaining quite innovative in a space that is changing quite rapidly, I think, as we see, payment systems change.
Yeah, I saw someone talking about, well, you just mentioned developing markets, and I saw someone talking about your very own native continent, Africa, and how that represents a great opportunity for Visa going into the future. I was going to ask Ben, is Visa's dominant position only going to get stronger as we move into a more and more digital world? As Heloise just said, return on invested capital figures all suggest that that's likely, and that's what's been happening. Are you down with that?
Yeah, I think, the sort of the companies that I look for are companies that do have a dominant market position. So you look at a Visa and it fits that perfectly. I think the other thing is as well, we kind of, quite a lot of the people, quite a lot of the time will refer to the debit card just as a Visa card, right? So it's that branding aspect to it as well. I look at it a little bit like a Coca-Cola. Even if you give somebody a glass of Pepsi, and somebody asks them what they're drinking, they'll probably quite often still say, I'm drinking Coke, right? It's this brand association with the product. And I look at Visa in the same sort of way. For me, it's one of those things where, yes, it might seem like an obvious, safe bet, but, at the end of the day, we're here to make money, right? We're not here to be exciting. So if I can own a business that can be predictable and can keep growing, keep its market share and keep doing all those things and sort of give me value as a trader and investor, well, obviously I'm going to want to own that stock. Call me boring all you want, but that's just kind of, what I'm here to do. I'm boring generally anyway, to be fair. So it's kind of goes hand in hand. But yeah, no, I agree with the other guys. I think, what I really like as well, a bit like sort of Pedro touched on it there, is they're not a company that's kind of being left behind as well with the payment space in terms of crypto and stuff like that. They are being involved in those types of things, and I think they're obviously, given the infrastructure and reach of the business, the billions they've got behind them, etc. Any kind of investment they need to make into that space, in a strong position to do that. So I think, all things considered, they are a very, very well positioned business. They're incredibly well run as well. When you look at the quantitative data on them and the figures, the growth that the business has year over year, you look at the balance sheet, the way it's run, the margins, return on capital, all these types of metrics, it's very hard to find a flaw. And I think the way that the business is as well, it just makes it a bit of in my opinion, an obvious pick. So yeah, I'm definitely in full agreement and alignment with the guys there.
Is it an obvious pick today? I wonder, when was the last time you added to your position, Ben?
So I've had the position for a few months. For me, I think, it's, when you look at the valuation aspect, obviously it had a little bit of a pullback not long ago. I think it's a sensible value. It represents the way that my portfolio is structured. They tend to be equal weighted positions. And then depending on how some of those positions have moved, I will rebalance. So there will be additional adds or deductions here and there, depending on how I need to rebalance the portfolio. I typically keep it, like I say, fairly evenly balanced across everything. So for me, it's quite an obvious thing to have in the portfolio, even at the current prices. Some might argue that the valuation offers a slight premium. For me, I believe a premium is worth paying if you're getting the quality to go with it. I think valuation isn't just a one-dimensional, earnings are this, price is this, and that's kind of how I have to match it up. You have to look at the brand and everything that kind of goes with that, right? Sometimes you're better off paying a higher PE multiple, a higher cash flow multiple, whatever it might be, if you're getting a higher quality business. Even if the growth aspects might be the same as another company, if the quality of that company is much higher, you're still better off paying that slight premium, in my opinion. So, for me, it is an obvious placeholder to obviously kind of go in the portfolio. MasterCard, I also hold the same as Heloise, though I have a similar position on that company. And yeah, for me, it's a bit of a no-brainer stock to have in there, really.
Yeah, I see it takes up 5.5% of your portfolio.
Mm-hmm.
And that's the largest stat. Heloise has a slightly smaller position, but it's her number one stock. It's the largest stock. And Pedro, I think possibly because he's been nibbling away at the profits, is a little under 2%. Just out of interest. Okay. Does anyone know the history of how Visa and MasterCard came to be this duopoly? How come it's just those two, really, on people's credit cards? Anybody know that?
I feel like you've got a story up your sleeve here.
I don't know. I'm asking from a position of ignorance.
I think some of it's the branding. Go on, sorry, Ella.
Yeah, I think it's like, so both of them were starting out of the banking system in the US, and then it just becomes the typical kind of chicken and egg scenario, because as Ben rightly points out, there's a lot of brand awareness with Visa, but often as the consumer, you don't get to pick whether you have a Visa or a MasterCard. That's sort of up to the bank. And then there's the more merchants that accept that card, the more people want that, or vice versa. The more people who have it, the more, the merchants will accept it. So it's really been a bit of a chicken and egg position. I don't think anybody really knows why there's only these two, but we sort of know how they started originally, and whether the new Credit Card Act will allow for more competitors to come in is yet to be seen. And if that's a good thing, who knows?
Yes, now that's one of the possible disruptions ahead, isn't it? And there are antitrust lawsuits as well, which could see the doors flung open, because Visa's got such a strong hold. Visa and MasterCard combined, it's crazy hold that they have over the whole industry. You know, all these other ways that people spend money using their phones these days? Like, I'm in Asia, and like, it's easier to pay with things with your phone than almost any other way for stuff in shops. You know, I joke sometimes, do you accept this technology, as I pull out a wad of cash and I explain that it's pieces of paper with numbers on them, and in exchange for the high number, they give me back smaller numbers. Anyway, it's hilarious every time I do it. Some of those are linked to, are those all ultimately linked to your bank account in some way? So Visa's not being completely excluded, even the more of these tech solutions pop up. Ben, you're nodding your head. Is that your understanding?
Yeah, so they're still involved in certain ways. Obviously, it depends on exactly what alternative option you're using, but there's definitely other methods and ways that they're involved. So I don't think it's a case of they're going to get suddenly excluded. And I think the other aspect and the other argument is whilst there might be more competition on that side, I think firstly the branding position and stuff like that, you know, you look at all these other industries. Again, if I use Coca-Cola as an example, there's a million beverage companies out there, yet Coca-Cola is still the dominant one. You get it in every industry, but there's still dominant players and still things like this. So, you know, I think you've kind of got to, they go hand in hand. And as we become more and more cashless, I think, you know, theoretically, you know, there's only more and more usage that also comes up as well. So even though their piece of the pie, even if it did get smaller, if that pie gets bigger, they're still able to grow as an overall business, right? So they kind of outweigh each other in that sense, in my opinion, anyway. I look at it kind of similar as well. You know, you look at the online payment options and things like PayPal, etc. So a lot of people look at PayPal and say, oh yeah, they've got less market share. Now, yes, they have got less market share, but they still have like 42% market share, and their customer base is still growing. So therefore, them as a business, they are still growing, even though they've got a little bit less of the pie. The pie's got bigger. So it's the same kind of thing, I think, over here with MasterCard and Visa, but I would argue that their branding and market position is stronger than that of, say, like a PayPal or something like this as well. So, yeah, I don't personally worry about those other things at the moment. Obviously, time will tell, right? And if we start to see signs of a change in a different way, then we adapt to it. But I think at the moment, I don't think it's, you know, worth worrying about personally anyway.
No, it seems you're more worried about Coca-Cola and pieces of pie. So it must be lunchtime where you are.
It is, as soon as we get off this call.
Well, so, I mean, we keep hearing people are going to cut back on spending. We discussed that earlier. It's not going to happen now. I've just been informed till later in 2024. But perhaps that'll be an opportunity, if things pull back, to buy a great company in Visa at a fair price, because it's had a big run up of late, and obviously I know that doesn't mean it's suddenly overpriced. And if it continues doing over the long term this, it could still be at a very attractive price today. I'm wondering what your thoughts are on that, about price entry levels. Pedro, would you be tempted to build your position up a bit more if the price was to pull back? And if it doesn't, are you happy to leave it as it currently is?
The way I see it and the way I manage my portfolio is always comparing Visa with something else. I like to look at target prices on some analysts, and they say Visa has a more or less 15% target price. So on that perspective, if I had to make the decision only looking at Visa, I would do it, because I comparing with the index, for example. So, but I reduce my the percentage I had, because I look at in the similar sector, in the financial sector, some stocks in Europe that are undervalued. We have to see that the financial sector is one of the most affected. There are worse than the financial sector, but more the big part of the gains were on the tech sector, on the communication services, consumer discretionary. But there are other sectors that are a lot undervalued. So, on that perspective, Visa, I think it's a good company, but I'm not adding, because I see in Europe other companies in the financial sectors that have a more risk-reward perspective of gains than Visa. But only looking at Visa, I think I would buy it if I don't have another place to put it money.
Well, when I check Heloise's trades, I see the most recent is the 17th of July of this year. Tellingly, that's the only one that's in the red. Obviously, probably not tellingly, but it shows you're still keen.
Yeah, absolutely. I think, it's always a difficult question to answer if you ask, will you buy a single stock? Because as Pedro rightly points out, it's a complicated answer. How does it fit into a larger portfolio? How does it fit into a bigger strategy? For me, it's fairly simple. I mean, this is a company that acts as an intermediary for payments. And the thing that pulls me to them is that they have the privilege where they charge a fee, but they don't extend credit. And that's really important, because that makes them very resilient during financial disruptions, which, as you know by now, I'm doom and gloom, and that's coming up. And people will continue to spend, even in any sort of economic downturn, even if that spending sort of moves towards the essentials. We're talking about moving to a more cashless economy. So I believe that people will continue to spend, and they will continue to do so. I like that this company is not exposed to any potential bad credit. And as I said, I like that they have really high operating margins, which means that they're sort of staying relevant. So they're not going to be outcompeted anytime soon. And then it's just a matter of, how does that fit into your strategy? Are you able to take a little bit of a short-term downturn, or do you want to sort of wait for a good valuation or a good price, or do you just include it in your portfolio in the long term? And for me, my portfolio is long-term, and if it fits into that vision of the long-term, meaning 5 years plus, then I'm happy to add it.
Well, that's an interesting chat. Staying relevant, staying ahead of the competition. That's what we're going to be talking about in part 3, when we discuss eToro and the marketplace that it finds itself in. But before then, here's another little musical break, and see if the viewer/listener can work out which of our 3 participants is lending their vocal stylings to this little snippet.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Yes, that was Do You Copy, featuring Heloise Greef on vocals there. Guest vocals halfway through that.
Archival material. Love it.
You always knew you'd be a pop star one day.
No, you need to have a backup.
Okay, so we're going to talk a little bit about eToro. As I always like one of the questions in these group chats to be about eToro in some way or another. You hear a dog barking in my background. Now, there seems to be quite a lot of other copy trading platforms I see cropping up here and there, mostly focusing on Forex, such as in Asia anyway. OctaFX, I keep getting adverts for that. Zulu Trade, I know a guy who's about to embark on a copy trading expedition on Zulu Trade. And they focus on Forex, and that's what eToro did initially as well. That's how it began, right? But I see when I'm on Zulu Trade, some of the website architecture suggests that they're going to develop it and they're planning to expand it beyond Forex into stocks, ETFs, cryptos, commodities. And assuming all these are part of the copy trading system, it looks like they're trying to become another eToro, or at least that's their idea, their projected plan. And I was talking to Wes recently. Don't know if you know him. Wes L3Y. He's a popular investor. Of course, you know him. And he was telling me he's investing in free trade through some sort of crowdfunding investment in the UK, which has been doing incredibly well and taking lots of market share in the UK. It works in tandem with UK tax wrappers, something eToro, I believe, has said is in the pipeline. The pipe seems to be of considerable length. And I also see other innovations for investors which appear to be complete nonsense, but I keep getting this advert for an investing platform where they claim they will provide you with the capital and you will share the profits once you've made billions and billions and billions. So there's all sorts of things going on. That's probably nothing new. There's all sorts of things cropping up all over the place. But the question is really, is eToro doing all the right things to prevent losing market share, to build its own market share? I think I've spoken enough in the build-up to that question. So, Heloise, can we start with you? Obviously, none of us, we're not going to be saying anything incredibly disrespectful of eToro. But within the context that we're all big fans of the platform, is eToro doing the right things to prevent losing market share?
Yeah, I mean, I think it's a very relevant question because people, the market has definitely changed from the massive onboarding that they saw during lockdown. Now we're going into a bit more difficult economic times. So people aren't necessarily having investing, at the forefront. So they're all definitely having challenges kind of expanding their market share at the moment. And I recently went through a very similar question. I think earlier this year or at the end of last year, I posted a video asking the question, if I had to choose eToro today, would I choose them again? Because I joined the platform in 2016, which, at that point, the landscape looked even different than it does now, or it did in 2020 when a lot of people joined. And at the same time, towards the end of last year, I think a lot of incumbents were joining in the UK. There's a lot of great examples, and getting offers from them to join their platforms. So really, like created this necessity for me to review my decision. And
are you announcing your departure exclusively on Copytraders Club? It's big news.
Well, you clearly haven't watched my video, Kevin. Sorry to disappoint you, but I think at the end of the day, the conclusion was that for multiple reasons, like there is no perfect platform. And it's about choosing a platform that works for you, one that you'll use, and even doing a really, really deep dive into the different platforms, getting hands-on with many of them. I think for me, eToro definitely still aligns in the core DNA with what me and a lot of other popular investors are trying to do, and that's to democratize the capital markets for as many people as possible. And how you go about doing it, is there a perfect recipe? Probably not, because it's a difficult problem to solve. But I think that they're doing, everything they can as much as possible to keep both their users, their popular investors, and their staff safe within regulation, while also pushing the boundaries of what's possible for the retail investor. I mean, they're just announcing that they're adding the pre-market or aftermarket trading, which they're continuing to innovate. They're continuing to see what's possible for the retail investor. while keeping people safe. And I think that's the most important thing for me. I don't want to be on a platform that's sort of just after making profits. Of course, they all will make profit. We're all here to make money. I'm not saying they shouldn't.
Mm-hmm. Ben, would you like to answer that question in a way that doesn't toe the party line quite so tightly?
Yeah, so I think there's a couple of ways of looking at it. I think obviously I haven't traded every single or used every single copy trading software out there, so I can't speak for them all. But I think from what I have seen, eToro is the best in terms of the platform, the simplicity of it, the way that it copies as well. It doesn't matter how big your account is; it does it on a percentage basis. Relative to your account size. A lot of copy trading systems, especially FX ones, it will just copy the lot size or things like that, which obviously can completely mess people up and doesn't give the same level of risk across the board. I do also, though, think there's the other side of it where, because there is more competition in the space and there's a lot of companies where it will be a case of, if you're managing X amount of pounds and things like this, it's that, you might get a percentage of profits and stuff like that. So I think when you factor things like that in, that maybe will affect how eToro does things in terms of the payment to popular investors. Rather than you being on a set amount, you might be able to earn more if you was managing the same amount of money elsewhere. So there is obviously that element to it, which I think they would obviously have to keep on top of if they're going to be in the space. But then obviously if you are a popular investor, that's good for you because there might be other ways of you being able to generate revenue and stuff like that. So, I think the competition can only be a good thing at the same time.
Okay, now social investing is always said to be one of eToro's main USPs. We're the market leader in social investing. But sometimes I wonder, other than in off-platform things like this, like the Felix Falex community, like individual efforts by PIs, particularly the bigger ones, to sort of deal with their own communities. What's the best evidence of social investing on eToro? Pedro, do you want to answer that?
Well, I think copy trading it's a way of social investing, and I think the feed is a kind of community in terms of investing. Of course, we see a lot of wrong things happening in the feed. I think if the feed could evolve to more quality content, to remove some of the things that are happening, it could be an excellent way. And even in that space, for instance, the creation of the pools, I think it's interesting. So the eToro feed, if it could evolve in a good way, could be an excellent space in terms of a community, in terms of social. But I really think that for me as an individual investor, and for instance in my second account, I do a lot of things. I like to trade. It's not only you, Ben. I also like to trade, but I do it in my second account. I love doing that with different instruments, with Forex. I love Forex. And for me, eToro, it's the best platform as an individual investor. And they are improving. I really love the trading view charts that I used before. And the eToro expansion in the US, I think it's critical because the US, it's the big market. And they are moving up in the US, gaining different authorizations for options, for stocks, and in a moment where crypto it's very threatened globally. So if eToro can manage to be in a good position in the US, mainly in the crypto space, I think eToro can have a good future, even for us. Even if it's possible for someone in the US to copy us, maybe our AUM could increase exponentially. So the moving into the US, it's a good step. We are seeing the conference in Abu Dhabi can also be a good space in terms of expansion to that region where where the oil became turned up to be a form of wealth for that region, maybe it's a right step also. So I trust the way eToro it's doing things. Of course, it's not perfect, but it's, as a customer, I like it a lot.
Yeah, it's doing lots of things right. There's no doubt about that. And as you talk about all those possible expansions, on the social investing point, though, when I think of the term social investing, and you see this on other sites, I'm sure we're all familiar with, where you put in a ticker and then it's presented in such a way that you can see various users have written articles or stock analyses on it. And maybe you can see some summary points on the article. Is the thesis long or short, that kind of thing. And then you can select the ones you want to read. And then there's some sort of managed, if this could be possible, like a managed comments section or questions submitted to the original author and then answered by that original author. So that reading it's like watching an interesting debate, and you get many people's intelligent input, meaningful back and forth. My problem with the feed is it's exactly what it's called. It's a feed, it's a moving ticker of information, and everything's fly by night, and there's no system to it. There's no infrastructure that organizes it in a really nicely digestible fashion. But the problem is, what I'm talking about would require infrastructure and human management. And I'm a bit concerned that eToro seems to be increasingly keen on algorithmic management rather than applying human resources to things. What's the other side of that argument, Heloise?
I definitely agree with you a lot on the social feed. I think it hasn't changed much since I joined in 2016. A lot of social media and the way we interact with our social communities, our online communities have become a lot more mature, and that we haven't seen that sort of happen on eToro. If anything, it's as more people have joined, it's become harder to manage your community, if at all, because you're sort of left to this feed, which just is sometimes a bit confusing and bizarre. However, I would say for me, social investing in the end, if you break it down into its two core components, and we had this discussion, we met with Gil Shapiro when he was in London in July, and we talked exactly about this, like what can eToro do on the social part to make it more useful, both for the popular investors, but also for the users, because we want to have these more mature and informed debates. But at the end of the day, if you ask what's the most important thing for a popular investor, I think it's the investing side. It's making sure that there are resources, that eToro is managing their order book in a way which benefits the customer to make sure that the fees remain low. And that's the things that they're focusing on. If you then add the social component to it, which really, this is all novel, this is all kind of evolving, happening as it's in real time. The most important thing for me there then is the transparency. And I think that eToro does wonderfully. I don't know any other platform that allows that transparency of historical investments or trades of an individual, which is really where you can learn a lot from other investors. So yeah, don't really have an answer, Gavin. We all feel the pain points. There's 1,000 ways to make it better.
Yeah. Well, I don't want to use this as a platform for suggesting they should do more to encourage their community to create content that's of value, even if it's not on the platform. I wouldn't want to go down that road. But Ben, any closing thoughts then on this issue before we wrap it up?
No, I think I agree with the guys that nothing's perfect, right? And whilst some people might find certain flaws in the way that eToro does things, they could go somewhere else and there'll be different flaws, right? Nowhere's going to be the perfect environment for it. I think, and this is my view on pretty much any service that you ever use, you've got to find a way of where you feel you find the most value, right? So whether that be having certain people on watch lists and they're the people that you focus on in terms of the content that they write, Whether it's a case of you just, have to maybe sometimes put a little bit more effort in if you want to find something on Visa, for example, or whatever, you go to that page specifically and then look at the write-ups that are on the Visa feed. And of course, if you want then a generic overview and just generally see what people are really doing, you use the general news feed. So I think you've got to use it in a way that best suits you, because everyone's going to want to get different usage out of it, and what everyone finds of value is going to be different. So it's impossible to get perfect. But yes, there's ways that they can improve, but I think there's a lot of things they do well. So, that's kind of why we're all here at the end of the day and why we continue to use the platform. So I think all in all, they're doing a good job.
Well, there you go. We've just ticked over the hour mark. Nothing's perfect, but the conversation we had today was pretty close to, I would say. Thank you very much for all participating, and hopefully we'll see you back another time at Copytraders Club. Who knows?
My pleasure, mate.
Yes, of course.
Thanks for having us.
That's all from me. See you on Discord and Facebook. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit-chat. We don't know your individual circumstances, etc., and so forth.